A very warm welcome to you all, and thank you for taking the time to join us for the Net Group Investments Multi-Manager Insights. The session has been tailor-made for you, our valued client, and it is really our hope that you find today's session both valuable and insightful as we unpack the topics that matter to you. I'm Tumisho Grater, and I have the absolute pleasure of welcoming you today. Now, we have a fantastic lineup for you over the next hour and a half. We will be bringing you insights from our industry experts from their various fields. We'll be delving into the fixed income space with Melanie Stockett at Laurium Capital, and she'll be sharing their current case for holding South African bonds. And then, of course, one of the key questions that is currently facing investors is how to engage your asset manager in terms of responsible investing. Well, we'll be getting some learnings from our head of responsible investing, David Levinson. Then we'll also be receiving an update from our head of client services as well as our senior legal advisor. But first up, we'll be hearing from our MD, Nick Andrew, and he'll be sharing his key focus areas for the business for this year ahead and beyond. So Nick, it's over to you. Thank you so much for that, Nick. Well, next up, we'll be taking a look at the performance for our exchange fund of funds. But before we do that, let's take a look at the operating environment in which we have found ourselves in. Now, just some of the key factors that we'd like to highlight before we take a look at the numbers in terms from an economic and market perspective. Some of the things that have been at play is the higher global inflation that we've seen, slower than expected economic growth, and all of these really has resulted in central banks tightening monetary policy. In terms of the domestic picture, what we have seen is that we have seen a slowdown in the domestic economic growth. A lot of that really has been resultant or was a result of the KZN floods, load shedding that we have had in terms of Eskom, as well as some global factors that we are contending with. For the South African inflation picture, we saw that headline inflation was markedly higher. And of course, this was on the back of higher food, fuel prices as well. So basically what we've heard of late is that the South African Reserve Bank has said that, the second round effects are now manifesting, and certainly when it comes to inflation, the risks are firmly tilted on the upside. So this is the global picture that we have, the most recent World Economic Outlook IMF survey or report that was brought in July. Basically, paints a picture that the global recovery has been, that we saw that was quite tentative in 2021, has been followed by increasingly gloomy developments in 2022. And we've seen how these risks had started to materialize. So basically, the story that we saw is that we saw global output contracting in the second quarter of this year. This, of course, owing to the downturns that we saw in China, in Russia. On top of that, we also saw the US consumer come under pressure, and of course, several shocks to the economy as well, which, this was on the back of the COVID-19 pandemic that we saw. And of course, then we had higher than expected inflation worldwide, especially in economies such as the United States, and of course, some of the other larger European economies. On top of that, we also had a slowdown in the world's second largest economy, being China, and the spillover effects from the war between Ukraine and Russia. So as we can see across all the regions, there isn't a single one that's been spared, with economic growth being revised downwards across the board. So one of the key themes for the year 2022 has been the concern around high inflation and slow growth, stagflation, which really is the slowing of growth with high unemployment, which is coupled with high levels of inflation. And of course, this means that, citizens such as you and me are faced with higher costs of living. Moving on to the South African picture, if we have a look at our economic picture, is that this was the first time since 2019 where we certainly or finally came up above, those pre-pandemic levels. So, for the first time in 2 years, we saw a GDP finally above those 2019 levels. And although we did see that, economic conditions had become a little bit better, unfortunately, our recovery was really also delayed by, the floods that we had in KZN, which we will be seeing coming through. But also, we saw the strike action that took place. We saw, acute power outages as well as slower economic growth as a whole. So this picture really was, one of the factors that has resulted in the slower economic growth from a, domestic perspective. If we look at how the economy has recovered, and if you look at the different sectors, so your primary sector, secondary sector, and your tertiary sector, we have seen that the recovery has been uneven, but there are certain sectors where it seems as though that there is definitely some scarring following the COVID-19 pandemic. These specifically found in the labor-intensive sectors. So when we are taking a look at the tertiary sector, for example, we saw that there was quite a lot of momentum that came through from, say, the manufacturing, power, domestic trade and finance. And of course, we also saw that high international commodity prices and relatively stronger global support definitely helped those types of exporting sectors. So those are the ones, the tertiary sectors in particular, that definitely benefited. And again, with the fact that we had a relaxation of those COVID-19 restrictions, we saw, your hospitality industries also, taking advantage of that. So although there are, there have been some issues that, that have happened in the past, and looking forward, there are a couple of things that we need to be aware of, and some pertinent issues from a South African perspective that we will be looking at. So, for example, if we're looking at our parastatals, Eskom and Transnet, there are still issues there, although in terms of electricity generation, there has been some movement there, but going forward, unfortunately, this will only really start to bear fruit in the next 2 to 3 years. So now, just looking at the medium-term picture, or the short to medium-term picture, the South African Reserve Bank has actually, anticipates that the more load shedding that we have, or the load shedding that we have had over the past couple of months, if continued, we would be able to see, economic growth being shaved off by as much as 1% for the 2022 year. Other things in terms of developments that are happening from the South African perspective, we are seeing positive moves in terms of the Durban Harbour, and of course the large infrastructure projects that are going to be a boost for the economy. But I think undoubtedly one of the big events that we're looking ahead to is the ANC election conference that will be taking place. Of course, all eyes will be on this because of the policy decisions already last month. What has been so, something positive was that we saw several high-profile arrests that were done, and then we obviously saw how the National Prosecuting Authority, or the NPA, and the Hawks have been outlining some of their progress on the fight against corruption, etc. And again, from a global perspective, and of course, these are still issues that will impact South Africa. Obviously, the hiking cycle that we have seen by the U.S. Central Reserve Bank and other major developed banks, and of course, this will have an impact or a ripple effect on how this turns out in terms of the South African picture. So while we have seen inflation move high, and of course this has been on all those factors that we mentioned, being fuel, food prices, the war in Ukraine, etc., it seems that both from a global picture and from an emerging market picture, which includes South Africa, it does seem as though we are reaching our peak, but although we are reaching our peak, and this is expected to be the end of this year or the beginning of next year, where we will see inflation start to come down, this is likely to come down at a rather sluggish rate. So in the interim, we are still expecting prices or inflation to be higher, but central banks will need to step in, as we have seen, in order to stop inflation from running away, so to speak. So again, that picture is both the same from a global as well as an emerging market perspective. And again, if we just look at what central banks have been doing, policy thrust has in the beginning been quite accommodative before we had inflation increasing, but now we've seen the big central banks like the likes of the US, the European Central Bank, the Bank of England, with the exception of the Bank of Japan, really moving in order to keep inflation under control. The South African picture is no different. We certainly have seen how these inflationary pressures have also translated into the South African market, and therefore we've seen the South African Reserve Bank step in and increase interest rates. In fact, we've seen headline inflation for July in South Africa reach 7.8% year on year, and the South African Reserve Bank seeing that firmly above the band. So we obviously are between 3 and 6%. It had now breached that upper limit. And going from now until the end of the year, the expectation is that we are likely to still see interest rate hikes coming through from the South African Reserve Bank. And to finish off in terms of our concluding remarks, in terms of the domestic and global picture, we know that global inflation has certainly been a factor. We are, at crisis levels, and no one has been spared. We have seen this come through from the developed economies to the emerging markets as well. And this has now resulted, obviously, in monetary policy tightening, the likes of the US Reserve Bank moving ahead and increasing interest rates. We've seen this with the other banks in Europe, but we're also seeing in emerging markets as well. And this also means that the South African Reserve Bank has also had to act. So domestic inflation risks, as we said, have now been tilted to the upside. And of course, now monetary policy is a lot more forceful in order to protect purchasing power. So in terms of the growth picture domestically, we know that there obviously are pertinent issues which we have highlighted, some including the global factors, but factors such as load shedding certainly being one of those pressure points, and that that is something that is likely to be a drag on domestic growth. While that is the global and local economic picture, I'm going to be handing over to Trevor Garvin. Of course, he is the head of Nedgroup Investments Multi-Management, and he's going to be taking you through how the exchange fund of funds has performed given this economic background. From myself, it is goodbye from me, but I leave you in his very capable hands. Trevor.